welcome everybody to our June roundtable. We have a great session in store for you all today. A couple of housekeeping items. We do have a Q&A available and very much encourage questions throughout the session. Our hosts will either answer them live or in writing. Additionally, we are recording this session, and we'll be sending out a copy of that recording after the roundtable has concluded. That being said, I would like to hand it over to our co-founder and CEO, Eloise Schmitz.
Thank you, Brittany, and welcome. Thank you all for joining us. I know summertime gets to be a little competitive with everybody's free time, so I appreciate you joining us today. And welcome to our roundtable, Expanding Volume with Non-Agency. As you know, we've been going through all the conferences. It's pretty clear that participation across the non-agency market is continuing to grow, with investors, with lenders, originators, brokers, and everybody's increasing their focus on these expanded product options. And as mortgage volume is expected to be flat for the next couple of years, non-agency is growing in volume and therefore in share. So it makes this really, really an important segment of the market for everyone to be paying attention to. The main driver of that volume is purchase volume, which we're going to be talking about, and specifically in investment properties and self-employed borrowers. I wanted to welcome my co-panelists. Today we're joined by Victoria Clement, the EVP Correspondent Lending at Newfi, an affiliate of Apollo Global Management. And Victoria has a wealth of experience, including over 15 years in leadership roles focused on non-QM. We've had the privilege of working together for several years, and I want to thank you for joining us.
Thanks for having me. Happy to be here.
We are also joined by Chuck Vaughn, the Managing Director of Correspondent at Logan Finance. Chuck has spent over 25 years in the mortgage industry with extensive experience, easy for me to say, in sales and operations and capital markets. This is Chuck's first appearance on our roundtable, so welcome and thank you also for joining us.
Thank you, Eloise. Appreciate it.
And there should be a little drum roll. Last but not least, I wanted to introduce and welcome Dan Smith, both to LoanNEX and to our Roundtable Series. Dan is our SVP of Sales. He brings over 25 years of mortgage experience, most specifically in software and SaaS platforms. He has been with LoanNEX for about 3 months. I have to say you've made already a big impact on us in a very short amount of time. You were previously with LendingPad, who is a great partner to LoanNEX as well, but welcome aboard, Dan.
I am so glad to be here.
Well, this is a particularly exciting time in the market. So we're going to just sort of kick it off, make sure everybody can see my screen. Is it up? Okay, good. As we've done in the past with our webinars, we're going to go through some market statistics and really want to make this as interactive as possible, including with the audience. So if you guys have questions, please chime in, leave them in the Q&A chat, and we'll get to those through the roundtable. But I wanted to talk about, what's going on in the market. And we put up this MBA forecast, which we update every month. And over I would say maybe 4 or 5 months ago, that orange line, the rate line, was going down in all years. And so we saw some increases in volume as a result of that forecast. And over the past couple of months, that is now showing an increase in 2026, which we've been sort of feeling, and then flat in the out years, resulting in flat volume. This is, a good time for non-agency, but it's a hard time for the market, so it's a little bit of a tale of two cities. And I know that Fannie has revised their projections. This is just the MBA projections, but Fannie revised theirs down slightly. So there is, I think, some question on what is the market going to look like over the next couple of years. And I thought I would, open it up with maybe Victoria, you talking about what do you guys see as you look forward over the next couple of years in the market?
Well, obviously it's hard to predict several years out, and that's why this forecast keeps changing. If you look at the Fannie Mae forecast, they actually have it down. They just revised their number slightly from this. The MBA has it relatively flat. Definitely, we felt some of the pain in the marketplace of just overall volume. Our customers, total volume is shrinking. But then again, as you can see on the right, non-QM is a greater share of that pie. So that's the great news about the product, right?
Yeah.
But nevertheless,
And
it's
it's,
still.
I think that chart on the right is so telling. Having been, presenting some of this data for several years, having that market share move that much, that's market share of total issuance. So to get that movement is really a reflection of how much has been going on in the non-agency space over the past couple of years to have that share actually go over 12%. So you can see in some of the comments or the notes down below, the issuance, MBS issuances reached about 61 billion in the first quarter, which was an 81% increase over the prior year. So that's what's pushing that share up. And Chuck, love to hear from you on sort of what Logan's thinking about the market and sort of where some of this opportunity is.
Well, I'll echo what Victoria says. Obviously, we see the market growing. I think right now some of the numbers we're hearing is, as far as true non-QM is 8%, growing to 15 over the next 2 years. The question is, especially when you start looking at the data that you provided, which obviously reflects issuance, is the elephant in the room that's not included in that, which is the insurance portfolios. So there seems to be a lot of demand with the insurance portfolios. So what that true number is your guess as good as mine, but there's definitely a lot of demand out there, and we definitely continue to see the market to grow.
Is it still sharing?
Well, while you're pulling the slide deck back up, Eloise, and I think great point, Chuck, about from a liquidity standpoint. The other side to it, as we talked about, is the changing demographics. There was a bullet point on that previous slide that said that 25% of borrowers are self-employed, and that number continues to grow. I was just reading last week in Housing Wire, I think was Ty Christensen, to give her credit, was talking about like a wedding photographer who built her business around those opportunities. And the mortgage company that she was dealing with didn't know how to see her, was the quote in that piece. And so this as this becomes to the forefront, you have it from the demand side from the borrowers, and then as you pointed out, Chuck, an increased appetite from the issuance or takeouts and the insurance and so forth. It's going to lead to that continued increase in non-QM.
Yeah, and I do think this is an important part, of the market. And what this chart is showing is some of that rotation. And it's not just rotating to the insurance companies, it's also a rotation back into the depositories. And so things that, frankly, the reason why LoanNEX started had almost everything to do with this chart. And that was, how do we bring back access to the private market, to an originator. And so you can see that blue sliver was gone. It was gone for so long. And now you're seeing that increase in the pie. But you're also seeing that increase of overall both private label securitizations and portfolio having an increased share of the pie. And that is, really, frankly, a healthier place in the market, but there's also an opportunistic place in the market. So there's a rotation going on. There's increased demand. Victoria, I love what you said the other day. You said, there's actually so much increase in participants that the liquidity might be outstripping the increases in demand. But, there's opportunities and sort of an explanation point on this part of the market because of that. So I don't know if you want to talk a little bit about some of that rotation, what you're seeing in terms of the participants and what that does for liquidity.
Well, definitely there's an increase in liquidity in the non-agency market. There's no question about it. As Chuck said, there's the insurance companies plays with we're both part of with Apollo and Newberger on his side, and also the securitizers. There's some changing regulation going on with banks too, which Chuck will talk about a little bit later. But this is great for originators. It means a lot of competition for people like Chuck and I, but it's good and healthy competition. And the variety of takeouts, depending on all of these, private label or portfolio options, and then private label securitization is really great for the marketplace. And to pair that with the increase in self-employed borrowers, that is not stopping. I mean, I've been in non-QM, non-agency for 12 years now, I think. And there was a time where no one understood what the word was or why we even call it non-something. But nevertheless, it's a household name now. And the majority of originators are starting to have some presence in this product. They have to, in order to keep going.
Yeah.
So I'm going to ask the reverse too, Chuck, and then I'm going to turn it over to you. There is an increase in liquidity. There is an increase in participation. But is there also, do you see a continued tightening of the box by GSEs?
Oh, that's a good question. I might have to phone a friend on that one. No, I think just speaking of liquidity,
we saw it with the second homes, things like that. So I'm just curious.
Yeah.
I don't know if that sentiment is still there of people expecting tightening, but I'd love your perspective.
Yeah, I'm not hearing at that point. Victoria, if you're hearing something different, please speak up.
I don't think so.
Yeah, I think if you just talk about liquidity in general, just kind of echo a few things, but liquidity is staying strong. The large demand across it, the two biggest ones are securitizers and insurance books. What we're hearing is losses are actually coming in lower than modeled expectations. So we're getting feedback that, hey, we really want to expand the box a little bit. You just obviously got to be very thoughtful about how you do that. But the liquidity is going to stay strong right now. The credit quality, the yield, the convexity profile due to the prepayment penalties, especially on DSCR, which is what makes these loans less sensitive to rate drops and reducing prepayment risk. So that just makes non-QM a more attractive option than agency right now. So again, there's more capital than assets right now, and I think we're seeing a demand for it.
You just led me perfectly into our next slide. So thank you.
I'm just trying to be a good host or a good guest. Trying to be a good guest.
So this is showing some of that yield curve changes, and we had been seeing an increase in rates really all the way through sort of mid to late May. And we're seeing them come down a little bit, just over the past week. So you can see the yield curve on the left side. That's pretty straightforward. On the right side, that's the the index for the 30-year fixed against LoanNEX indexes. So just to give people a reminder, that green is the DSCR index across all of the different investors on our platform over time. The gold is sort of that prime part of the credit box. And then the silver is little lower FICO, little higher LTV, so a little bit of a worsening of the credit profile. And we saw a little over a year ago the convergence of DSCR and our gold. That was like a big thing when we saw those converge, because DSCR was always behind. It was always about a 25 to 50 basis points behind the gold. Those converged, and then the DSCR really started trading inside the gold and tight to the agency as more liquidity came in. And Chuck, as you just said, relating to those prepays and things like that. But we're seeing that tighten even more. And for the first time, we're seeing that DSCR rate might only be for that 1 week in time, but we see those two converge. That's a pretty big shift in terms of I asked that credit box question for a reason. I don't see it changing really either, but the demand and the more capital than assets is driving some pretty interesting pricing opportunities. We're encouraging everybody, as you're talking to your borrowers, make sure you're looking across all your options, because some of these options may be better priced for your borrowers than an agency option. And it might not always be credit box, but it may be pricing and, frankly, then, execution with your partners. But I don't know if Chuck or Victoria, you want to sort of talk through that.
Well, I think on DSCR, clearly it's a growing pie as well in terms of the overall non-QM book. At least, Eloise, didn't you say yours was like over 50%? I think of
yeah. So and we're gonna talk through that, but yes,
okay.
On our platform, investment property is definitely over 50%, usually around 55. But this is not based on volume. This is straight up rates, just
I only
not volume
comment on
adjusted.
it. Yeah, I just commented on it because as rates converge with agency in that product for this 1 minute in time, possibly maybe longer, it'll linger. Obviously, that motivates more people to enter the market. And we're seeing also an increase in that part of our book as well. And that's typical in a rising rate environment or a flat rate environment. You're going to find more business purpose focus. And so the fact that you're doing so much of it is a really interesting mark, I think, for all of us to note. And the non-QM players that are in the space are in both the non-QM bank statement, full doc, type products, as well as the DSCR. And I think that's really important to diversify.
And Victoria, I think you made a really, great comment about that, because I was actually a little over a year ago on this webinar series. Your colleague, John Wise, was making the comment that as investors, get a taste for this, then their appetite is almost unsatiated, right? They just want more and more.
Right.
And so it leads to, as to your point, kind of a virtuous cycle, in that then it becomes more compelling, in many cases for the borrowers, and you end up with that uptake and increased interest across the board.
Yes, exactly.
That's a great point, Dan. Thank you for bringing that up. And what we love to always point out is DSCR is repeat business, and it's a faster repeat cycle than straight owner occupied purchase. So this is a very interesting time and part of the market.
Right. And for those that aren't in the DSCR space, probably most people are that are on the call, it's a much easier loan to do. There's less restrictions on licensing. It's focused on the collateral, the liquidity, the LTV, the DSCR. Of course, coverage is really important, but we can get into that offline as well. But it's easier to scale.
Yeah, so I'll focus on the right side of the page first, because we were just talking about that. So you can see these are stats on the 50,000 scenarios, which is equivalent to, approaching $30 billion of loans priced per month. And of that, investment properties are just over 50% for LoanNEX pretty much all the time, with DSCR being about 50% of those. But it feels so often to originators that we're talking to so hard to get into this market with some of the alt income doc types, but it doesn't have to be that daunting. So I don't, Victoria or Chuck, if you want to talk about, full doc has its own sort of, I don't know, profile or type when you're in this part of the market, because it's not, those are prime jumbos, those are prime jumbos with higher leverage, those are prime, higher at loan to value, I should say, or with lower FICOs, but they're not in the agency box. And so, that's one side of this, but also then the bank statement side is getting easier to qualify because there's more tools. How do you talk to originators that are coming into this space and trying to navigate all these different options?
I'll jump on that one. I would say, to me, the biggest value is having a knowledgeable AE. Whoever you're working with at the lender of your choice, if you have a knowledgeable AE who's going to be able to structure a deal to get it through the process, because every single investor has their own little nuances, and if you are aware of those hurdles when you get it into the file, if it's going to go through the process just easier. It's going to be easier on On the investor, it's going to be easy on the originator. So to me, that is the, the tip of the spear, is having a knowledgeable AE who can help you navigate the system.
Yeah, just to add to that, take it a step further, a scenario desk support.
Yep.
Underwriters will learn as they go, but building a brain in your office is really, really critical. What exceptions are investors doing? What are trends in the marketplace? Get to know, of course, us and the buyers out there, and what's happening. That is almost as critical as having an AE who's knowledgeable, which some are learning as they go, but having that home office support. There's a big difference if you don't build structure around non-QM. It needs to happen.
Agree. Yes.
So I want to talk a little bit about both sort of volume trends and channel trends. And I know that Dan, in your experience with LendingPad, you saw some of these sort of channel trends as well. But you can see on the left side, this is volume on LoanNEX. These are just unique loans priced on LoanNEX, and you can see the growth year over year, even though there's some seasonal peaks in there. But there's obviously an up and to the right trend going on, which is important. But what we have seen is, a lot of that is also, a lot of it came from people that were more comfortable in this space. Historically, there was only about, 10% of brokers that were active in this space, probably a higher percentage on the lender side. But what we're watching now is growth in the brokers, but also a lot of people moving from brokering into non-del, and then from non-del into delegated, and then from delegated into bulk. And so, I'm going to, flip it between Victoria and Chuck, you both. But Victoria, can you talk a little bit about how people are moving even from that correspondent side into the bulk side, and what trends you may be seeing now?
Sure. The nice thing about, I think, both our companies is we have options for all of those channels, right? We have a robust wholesale channel, which we get leads from as customers grow up and become non-del. They get a small warehouse line, they want to close loans in their name, but they still want to lay off the risk in terms of the underwrite. And then, of course, the correspondent channel where I sit is, buys closed loans. And then we have Apollo, our parent company, who buys bulk, right? And we work with them on mini bulks as well as forwards. So there's a lot of options in our platform to meet the needs of a growing customer. You asked about correspondent versus bulk. I'll take that part of the question. It's a really interesting environment right now. Obviously, there's been a ton of volatility in the last couple of months because of what's going on in the world. And nailing down pricing and hedging strategies in non-QM, which we could talk about forever, is very difficult. We have some of our largest bulk sellers moving back down the chain to forwards, meaning flow forwards, just guaranteeing that credit risk can be laid off in a variable rate sheet environment, and then back to flow. And we have sellers that are bifurcating now. They're doing some bulks and some flow. And so it's just important to pay attention to what's happening in the marketplace, which we're all professionals in this business. We know, we watch rates. But it's a difficult product to hedge. And for that reason, it's also important to make changes quickly, which a lot of sellers have done. I expect that as the market stabilizes, if it does, whether the rates are high or low, some of these bulk sellers will go back to bulk because it's just easier for them to originate that way operationally. But nevertheless, we've seen a big increase in our flow activity from bulk sellers as of late. I think it's a smart move.
Yeah, and Chuck, I'd love to hear how you guys are helping people even go from wholesale into the correspondent channel, and what you guys are seeing.
Well, I think that's, channel migration to me is just a reflection of the maturity of the channel. As people become more familiar with the product, they become more comfortable. They're going to go from, wholesale into non-delegated. Obviously, not taking the credit risk, but getting used to it. Maybe even doing some ghost underwriting on their side just to make sure that that they know what they're looking at. I think as they get more comfortable, even in the non-del channel, that's when they start looking at taking that next step into the delegated channel. And as the flow or the channel migration would dictate, you start off with underwriting to the investor guidelines and doing flow business, and then those that have the scale and the expertise can make that jump to where they start doing the bulk delivery. So for us, it's really about making sure that our clients are ready to take that next step. We provide them training and any kind of resource they can to help them along. But at the end of the day, they got to have a comfort with the product and have an expertise that they've developed over time.
Yeah, and Dan, you have an interesting perspective because you've worked sort of in more of the LOS and platform side. What kinds of trends are you seeing both in your new position here, but also what you were working with in the past of people navigating between wholesale and core?
Yeah, I mean, and sometimes it's done fairly seamlessly. And, as Victoria mentioned, there can be changes and oscillations, even, it's not necessarily just one direction in that. But I would say from a trend standpoint, it all plays together. I mean, just as Victoria had said, this is a bigger piece of the pie. And so just from one standpoint, the sheer volume, once people hit kind of a critical mass, then they look to do that migration that Chuck just laid out, right? And as Chuck said, you make sure they're ready, get the training, willing to take on the credit risk. And so there's sort of a compliance aspect that can come with a critical mass. But both, previously and now, definitely, and in fact, there's a connection where I'm talking to some of my lender clients that I knew from my LOS chapter have been reaching out to me and saying, hey, you know what? We are really interested in getting more into non-QM, and to this point we've either referred it elsewhere, we've just brokered it out. Now we want to take it in house. So definitely seeing those migrations.
There are a lot of really interesting trends with that. And as we were talking in advance of this, understanding how the push has been, and we've been fielding a lot of calls on how can we help hedge? How can we help watch the market? How can we help people protect? But it's not, easily done in this part of the market, Victoria, just as you said. So it's really important to be able to keep an eye on that, but also navigate, between your delivery approaches. I wanted to switch it up for just a second. And this is not something I always talk about on this webinar, but I think this is a good time to talk about it. And that's the green line on this page. And it's probably a line that we always, sort of run right past, but I think it's important as I'm looking at some of the trends. And that's, of all the loans that were priced, how many loans actually met an option for that originator. And when the volume spiked in March, we saw that loans met drop just a little bit. That means people were pushing the boundaries probably a little bit more in that market. So we saw that percentage met drop some. But none of our clients, and Logan and Newfi are not any different. If we pulled up their specific stats, their number is going to be lower. And every one of our clients' numbers are lower. But what's important, and the reason why I wanted to raise this is, it is important to have a few investors or a few lenders options in your portfolio because it's going to give you broader coverage. It's very rare that someone's going to have 100% coverage because some types of scenarios that you're running just aren't, you can see this is across our whole platform, aren't going to get you to 100. But it's really important to have that coverage. Some of it's based on all the different kinds of loans on the right side, different kinds of income doc types, different kinds of FICO, options. But you guys know where you participate. But if you want to talk about, I don't know if you can talk about sort of your trends of where you're seeing or how you advise people, because there is a broad market. And some of the things people are looking for or your borrowers need are a little bit broader.
I would, if you don't mind me jumping in, I would say you got to know your investor's appetite, because that's really what it comes down to. Every investor has a different appetite. Some might be chasing wax, some might be chasing performance. It just depends on what everyone's chasing. I know, our parent company, Newberger Berman, they love the 740 plus. That's where we're super strong. That's where you're going to see us at the near the top of the stack, if not at the top of the stack on most scenarios. So we know who we are, we know what we want, and we know what we price for. So for us, that's where we're real strong. There may be someone else who's really good at below 720. Those are investors that you have to have in your portfolio as well. So you just got to know who your investors are, what their appetite is, and then have those options available.
Yeah, and I also think it's important for those getting into the space, or even those that are still there, to choose a couple different investors that have different exit strategies.
Mhm.
Chuck being
That's a
owned
good
by an
point.
insurance
Yeah.
company, right? So portfolio buyer, like an Apollo at his parent company, or we just did a securitization. So, those that securitize as well in the marketplace, they're answering to the rating agencies, and there's other factors at play there. So I always tell customers that are new to us, or new to the business, or even ones I always ask, who are your buyers? And I said, that sounds great. There's a variety of exit strategies in each one, and that's what you want, because it gives you the best options for both product, but also price, right? And appetite. And everyone's is slightly different. I mean, there's definitely things that have converged in the marketplace over time, as we all sort of look like the same meat and potatoes. But then there's those that have foreign nationals and, other types of products. Some people really are very focused on seconds, and other options too there. HELOCs is a great example. So, that would be the fourth reason to add, an investor, like an business.
Exactly. And I'm going to ask, does that then play out also in purpose? Or do different investors have maybe a different appetite, whether you're looking at some of the cash outs versus some of the purchases?
Sure. I think also states come into play.
Oh, yeah.
And the diversity of an investor's book, or what's happening in soft housing markets, or fraud. We had a bit of that, last year, which was not very fun for any of us. And so, people overlaid soft housing guidelines. Those are real, and they do exist, and you pay attention to them, right? Some investors got hurt worse than others, and they're tougher in certain areas, as they should be. But, we all want to be good citizens in the business. So we're all sharing that information amongst ourselves and each other, and it's important to pay attention to that stuff, because you'll find some trends there by
And that's
investors.
just part of the maturation process, right? And we were talking about these new entrants and this increased attention and the bigger share. So you have new participants, and they're going to kind of people, provide different options, and sellers will find different lanes, and that's we're relatively early in the stage. I think that will continue to evolve.
Yeah, I think every investor has their own sensitivities and what they look at and what's important to them. So again, it's knowing your investor and having an option of investors that you can choose from. Obviously, their files fit in several different places, but some files don't fit everywhere. So,
very, very true. And we're going to dive in a little bit maybe into some of the purchase market. I thought some of these trends were interesting as we look at just the purchase side for that primary home versus investment property. And then that primary home side, we're seeing still those purchase numbers remaining really strong. And a lot of those you can see are in that bank statement. These are self-employed. 36% are on full doc, which means almost 2/3 of the volume on the purchase market is in an alt doc, self-employed type of borrower, and that volume is going up. We saw a bit of a spike in the average loan size in May. There's nothing that I can say that attributes to that, other than there's a little bit, with some of that increase was driven by some of the more jumbo types of properties. But Victoria, maybe you can talk about what that primary home purchase market looks like, because there's some in the full doc side, and like we talked about a second ago, some investors may be stronger on that full doc side, some might be stronger in the alt doc side. But this is really important to be comfortable serving this part of the market while we're in a purchase market. And I'm talking to the originators that are sort of dabbling in the non-agency space, or they may make only 5% of their total volume. But this is a pretty important, sort of rounding out of offerings that you really have to have access to, have to have the brain, I think you said earlier, Victoria, in your organization to serve this part of the market.
Yeah, there's a couple of things I want to talk about on the slide, but you can see the variety full doc bank statement. Alt doc is the P&L loans, CPA letter driven type income analysis. And that's gone down a little bit just because more people are actually doing the work to provide the bank statements, and we're getting better on the technology side on that. So it's definitely still the majority of the market versus the investment side, I think, in overall everyone's book. So it's important to have both. I think things, change over time as one becomes more popular than the other. But I wanted to comment just a little bit on full doc. We show it here increasing, and it definitely has, but there's one reason why it has is because of those rates getting closer to jumbo prime. So you have a full doc borrower that has a choice, right? If they're giving, their W-2 wage, they've got full, tax returns, they can go, jumbo prime or agency, or they can go non-QM. The reason that they were going non-QM and still are is because of the premiums, especially in the wholesale market. We pay higher premiums on that product. We have seen some investor appetite really shifting in that quadrant in the last month. We're starting to, as well as other buyers out there, put a cap on that premium, 102.5 instead of 103 or 104 or higher. And that may reduce that pie a little bit. It may flip those people back to jumbo prime or agency, wherever they fit, but it's really a price game. And as you talked about those rates converging on that grid, that's why that's what's driving that right there. Because full doc is not traditionally known for non-QM, unless it's an IO or something, right?
That is really, really good insights, and it's super important. And I would say for the originators that are on this call, that makes it even more important for you to be able to watch the market and be able to see, because they may flex in and flex out. And as you're looking at those options, always seeing, is there a more efficient way? Or, before you turn down that borrower because they're self-employed and you're intimidated by the bank statement, these are great products that don't have to be, sort of ignored. This is really, really an important part of the market to serve, to serve more borrowers, and to just as you said, Victoria, really look as these rates start to converge, there might be a better option for you, depending on, sort of where the demand is. Chuck, I don't know if, you have other observations, but I appreciate that, Victoria. That was a really good way to think about, especially from an originator's perspective. Why is this happening? How should I be behaving? What should I be looking for?
I'll get in front of this. I can't outdo what Victoria just said. She covered it all. She stole half my notes there. So she's just more eloquent the way she communicates it. So I'll go ahead and defer to the next topic.
Yeah. So the investment property side, the volume hasn't grown as much. So we can see that primary home side growing, and I think that has to do more with accessibility, comfort with the technology, things like that, things that you were talking about, Victoria. But the investment property side is sort of a steady, constant part of the market, at least on the LoanNEX platform, because I know we over-index over here. But this is almost all DSCR, and little bit of shifts in some of that activity. But I don't know if you guys want to talk about, some of the other trends, or how you all approach it, how you want, the audience to be able to work through these programs.
The only other thing I would say is that, as I commented before, there's a lot of growth in investment properties right now. Investors like it. It's got a prepay on it. And not so much when rates are flat or increasing, but when they look like they were going to decline, that was a winning game for all of us who are buying these loans because they have slower speeds, right, with a prepay, or at least you're covered if they do prepay. So, that's why the rates have converged a little closer to agency. That's why there's more liquidity in the marketplace for this product. Combine that with its easier product to originate. It's a winning combination. And so more and more of our originators are getting into this space because you said, Eloise, repeat business as well, right? You've got that small investor that bought his first or her first, and now she's buying the second or third in a college town where there's a lot of opportunity. So, I think this says it all right here. You kind of need to have both.
Yeah, I think. Go ahead, Dan. Sorry.
I was just gonna say, in the same vein, you have this notion, and it's correct, that non-QM is filling a need. It handles solutions for folks that don't qualify, but they would be good borrowers. But to this point, it's also more than that, especially with the convergence. It's also about options and what's the better avenue. It's not even necessarily will you help someone get into a loan or not. It's also just a tool. In some cases, and you just spoke to it about the full doc not agency, that should be part of your panoply of options. Chuck, go ahead.
Yeah, I think people are starting to figure out it's an easier product to originate. So I think the challenge that some originators are going through is, where do they get the lead sources? How do they develop those referrals? So I think that's probably the big thing. And I think they're figuring that out too, which I think the DSCR market is going to continue to grow. People are becoming more comfortable where they're understanding that licensing is a little less or a little easier. So I definitely think that again, it's just part of the maturation of the entire market. But I think DSCR is definitely one that the LOs are starting to figure out at a pretty quick pace.
Yeah, and I wanted to take a chance to sort of talk about, we've been peppering it in throughout this conversation, but Victoria, I'm going to have to give you props for the quote because I loved it. It's really about what non-agency is. It's a bigger portion of a smaller pie. And if you don't, this is what we've been saying at LoanNEX for a long time, if you don't give your loan officers the tools to compete in a smaller pie, then they have fewer and fewer options to be successful. So really, we've sort of lined out some ways to be successful. If you're doing this and you're sort of putting your toe in and it's not really open to all your loan officers, it's really important, and doesn't have to be intimidating to participate. You've got the purchase market that has an over-indexed share of self-employed borrowers. You need to be comfortable in this space. You've got an ability to leverage your platform for investment properties, and they are repeat borrowers. The best thing that we can recommend is to lean on your partners. I think you said, Victoria, put a brain in your organization that then can train and teach others how to do it. And I'm gonna have to say, leverage your technology. But Chuck, I'll give it to you first. What are your tips as people are trying to go from, I dabble in this, but I really need to get it, into a bigger portion of my business in order to really compete?
I think the biggest thing right now is just kind of keep educating yourself on what the market's doing. I know we talked a little bit about some of the legislation that's working its way through the House and on one of our calls, and it sure feels like regulators are trying to incentivize the depository institutions to get back into mortgage. I know the recent bill that's went through the House, what was it, 6644, I believe, is going to give some capital relief, if you will, on the 1 to 4s. Now, again, that's assuming that they're gonna grow their book of business internally, but I think that coupled with technology is going to make it a lot easier for the depository institutions to start getting back into it, not have to worry about the additional headcount that they have to carry during the spikes and valleys of mortgage. So I think if you see what the market's going to happen and how much more competition there's going to be for agency business, that non-QM, especially for the independent mortgage bankers, it's going to be a growing percentage. So, getting ahead of it now, getting educated, getting a level of expertise, and finding the channel that works best for you is going to be the best thing you can do right now. Just be prepared, because I think the agency competition is going to increase in the years to come, probably fairly soon. So I definitely think having a focus on non-QM as a higher margin business for you, better revenue, and it's going to be one that's going to be a focus of the IMBs going forward. Should be.
Yeah, I'll add a couple things to that, and I want to make sure we get this on the table too. When you choose a partner, there's a lot of great partners out there, and so.
Oh, Victoria, you're on mute. Oh, okay, good.
Oh, how about now? There you go.
We got you.
Anyway, there's a lot of good choices out there. Choose a partner or a couple of partners that are thought leaders and can share trends developing in the marketplace. Right now, because properties have been they've been up and to the right, going up in value. People are paying exorbitant prices for them. When rates kind of come down, stabilize or increase, and that music stops a little bit, which it has slightly, as you can see by, the spring buying season that we just got off wasn't as great as it was last year. There's more focus on liquidity on the buyers, and that means collateral liquidity and appraisals. And we've seen some trends away from really good quality appraisals out there. And so we're spending a lot of time with our customers looking at the pictures, looking at the homes, looking at the comps, going through them in much more detail, and not just relying on the AMC, the comps, the CDAs, the CU scores, the AVMs, all those tools. They're just not as good as they were when they first came out. They're not perfect, and we're asking ourselves to just take a closer look. And I think there's going to be more of that scrutiny coming from the industry. The rating agencies are already talking about it, the portfolio lenders, because they care about liquidity. And a lot of investors are doing some reviews up front. So, investors and buyers like ourselves and many other great ones in the marketplace, we're here to help with those questions and solutions and walk you through what we're seeing. So make sure you pick a partner that's going to give you that data quickly. Here's what's happening in the marketplace. Here's what we want you to be aware of. Here's what we're seeing. Let's be good partners together and, do some good business, right? And make sure it's the quality and longevity that we want it to be in the space, because it's great for non-QM, as we grow.
And I'm going to say, I was going to say too, some of the things that we see is some of those soft guides evolve because of what you're talking about, what everyone's talking about, how you approach declining markets, or what you do in a gift fund environment, or how you handle the 1-to-4s and some of the investment properties. Those are some of the little nuances that should not be intimidating. That's what LoanNEX is here for. We can give you a way to navigate through what your borrower needs. And if you remember, we've got those guideline Q&As that are available to you that really walk you through what to ask your borrower to be able to qualify through these loans. So please lean on your partners. As everybody has said, make sure you've got a good cross section of partners that's going to cover the market and give you, I liked what you said, Victoria, about that, your partners, you make sure they have a variety of takeouts as well, whether they're going in the securitization market or they're through the insurance market, because that's going to give you different price points at different types of events in the market as well. But being a problem solver for your borrower, that's what this is all about. That's what drives repeat business. That's what drives referrals. And it doesn't have to be intimidating. It really doesn't. So lean on us too if you want to understand how to sort of get that brain inside your organization and to be able to, ensure that you're seeing all the options in the market. I cannot believe how fast this time has gone. So I want to really quickly give a chance. This deck is going to be distributed out to everybody. So, I wanted to say, Chuck, if you wanted to say a couple of quick words on where Logan's participating, sort of where people should contact you, things like that.
Yeah, so just a little bit. I mean, here at Logan, we value consistency. We feel it's important for our partners to, have a repeatable experience with Logan. For us, it starts with pricing execution. We know what we want. We know what we pay up for. We're going to be strong in bank statements and DSCR. Above 740 DSCR with 3 to 5 year prepay. We do a lot of it, and we like it. We want it, and we price for it. So, as far as operation support, as I said earlier, to me, communication is the foundation of a relationship. And we not only we're going to communicate with you through emails, through the portal, but we want to pick up the phone. We want to talk to you. We want to make sure we keep that file going through the processing and get it purchased as quickly as possible. I mean, that's really what we're trying to do, is that consistency and repeatable experience. As far as scenario driven, we're all about having a knowledgeable AE that's covering your account. As Victoria said, we got other resources available as well. Great underwriters that we contact frequently and get them involved as needed. But to me, the upfront is basically making sure you get that file structured so it can get through the process. Marketing and training, that's something that I think every company provides. We do a great job of it. We have white label marketing we can provide to you. We also have Paul Jones, who runs our training program. I know he's been on this call several times.
Yes.
Just a great resource. He's very knowledgeable, and we can do some training on product. We can do it on referral development training. So there's a lot of resources that we have that we try to support our customers with. So, in closing, we encourage everyone to partner with organizations like Logan and Newfi that are vested in your success and helping you grow your non-QM business.
Agreed. Thank you. And again, this is going to be distributed out to everybody, so with contact information. So, Victoria, you want to talk a little bit about the Newfi products?
Yeah. By the way, I love Paul Jones. He's a great guy. I
Yes.
love working with him for over the years. So Newfi's an affiliate, or actually we're really a subsidiary of Apollo, who you all probably know. They are the largest buyer of non-agency business in the marketplace. For the for sale side anyway. And, we've been around for a long time, primarily in the wholesale business, run by Steve Abreu, who's a longtime compadre of mine and business partner with everyone. A lot of people. We've purchased over 17 billion in residential mortgages. We have a variety of products, just like Chuck and others, and some unique niches, which, when you get to know our AEs, they'll certainly train you in all of that. And our goal is speed. I mean, we move fast. We fund every day. We have sharp pricing. We use some technology that we can provide to you, but we're also flexible on our exception process. There's a lot of exceptions in this business. Someone said it was up to 30%. So ask the questions. There may be a home for it within Newfi or within Logan as well, or others. It doesn't matter. But the key comes down, like anything, to customer service, right? We want to partner with you. We have a small group of customers. We're adding more. We've been in this business, the correspondent business, just for over about 2 years, 18 months or so. And we're very selective, as you are, with who you choose. So, you get a lot of options. You get both a portfolio with the Apollo, but you also get, securitization to take out with us as well. So that's the reason that we're here. We want more. Right? It's a good business for us and
Yes.
for you.
Yes. And please reach out to Victoria or Chuck. Their information will be in the deck that's getting distributed to you. But also reach out to Dan or to me. We're here to help you find the right solutions, both for discovery, scenario testing, even full pricing engine services. But we're a great partner with our partners. So please reach out. We'll make sure that you've got the coverage that you need, as well as the tools that your loan officers need to be successful. So Dan, anything you want to say before we conclude?
This has been a pleasure. Thank you for including me in my first of this esteemed series. And, just one thing I wanted to mention as an indicator of the increased attention around that bigger piece of the pie, as Victoria has coined it, is, from a year ago, we were talking in the prep, and it was noting that this was a higher level of attendance than, where we were a year ago on these webinars. And I've also been just sort of watching the attendees who, and obviously this will be available in a recorded version as well, but the attendees have really held. So that is a testament to the great content that Victoria and Chuck have provided here. And it also suggests that if you are a seller, if you're a lender, looking at this, then not only should you get into non-QM for offensive reasons around, expanding your volume, the savviest LOs, Chuck made the point earlier about, is your institution ready? Your LOs, your savvy and successful LOs are ready and they're looking for it. And that is an opportunity to attract and then retain. And so it's just vital. It's complementary. It's not this cyclical fad. It's here to stay. It's here to grow. And just like Eloise said, we're so honored of our partners, and Newfi and Logan are great partners. So thank you very much.
So it works both
Thank
ways.
you, guys.
We appreciate
Thank
LoanNEX
you.
very much, and thanks for the opportunity, Eloise and Dan.
Thank you very
Well,
much.
thank you
Appreciate
guys thank you guys so much for joining us. And we didn't really have any questions from the audience, but feel free to reach out to anybody that's been on this webinar directly if you do have any questions, and we really appreciate your participation. So Chuck and Victoria, thank you very much. And we will see you, I'm sure, at the next conference. So thank you.
Thank you. Take care.
Thank you.